Yeah, hello everybody. To global economics. In the end, the hardware works. Last week we did a short revision of the ISLM model, but from a little bit more theoretical point of view. And there especially I showed you that all what we have talked about in the introductory course of macroeconomics of course also applies in general if you do not have just linear functions where we solved in general the model for the equilibrium and then talked about once, or the first one was fiscal policy. Here that then we said, well, we change externally the amount of government spending, and that then graphically this would mean LMIS, that the IS curve is shifting outward, and we argued in the introductory course then that we obtain an increase of interest rates and additionally also an increase of output of income overall. And down here we deduced especially the dependence, the general positive dependence of income on an increase of government spending, just from our general assumptions, how look like the dependencies of money demand on interest rates and money demand on income and consumption on income and investment on income. That from the assumption that consumption is positively dependent on income and is lying between 0 and 1, the negative dependence of money demand and investment on interest rates, and the positive dependence of money demand on income, that from this overall we obtain this positive dependence. Well, and if you then want to do economic policy, then you are going back into the data and then with econometric estimations, you try to estimate all these dependencies. How large are they? That you then overall not only obtain this, that this is a positive number, but especially when you are looking at fiscal policy, what you want is that also this number is larger than 1. So from an economic point of view, this number should be larger than 1. And why should be this number larger than 1? Well, of course, the first impulse is you want to push output, that you in general get an increase here. But also you have to keep in mind government spending is not just coming from heaven. Somebody has to pay for it. Think about these 500 billion program in Germany right now. Everybody is now applying for this. For example, Berlin wants to plant trees. This was, I think, the last days in the media. And 2 billion, I think, over the next 10 years they want to use from this money. Well, since this 2 billion for the trees in the next 10 years do not come from heaven, from whom this money comes from, it comes from you when you are starting to work in 1, 2, or 3 years. Then you are paying taxes, and in 10, 15 years, this has to be repaid. Well, and because of this, then hopefully this number should be larger than 1, because why? Then you have a larger impulse than you are paying. Well, and actually in the winter, it was around October, November 2008, after the Lehman crash, and we at the, so to speak, peak of the financial crisis. In Germany, there was the question, what should we do? Should we really go from the government into the economy, initiating large programs in order to stabilize it? And then especially it was the question, is it really helpful? Is this number larger than 1? And as I said, during this time I worked for the economic, for the scientific staff of the economic advisors. And so also the government came to us and asked, because especially all our scientific economic institutes in Germany, I don't know if you know CESIFO, DEW, and so on. I gave you in the introductory course a little slide where I put all these institutes on. Well, they were also asked, but nobody really came to the government and said, well, I have an idea how large this number is. Is it 0.7? Is it 1.2? Is it 1.8? Something like this. Well, and then actually a friend of mine and myself, we did a little calculation, and with this calculation, Mr. Rürup then went to Berlin in the beginning of December, and we estimated this number for Germany to roughly 1.3. Well, of course, this was not the only reason, but after that, we started in Germany a program of roughly 80 billion euros in the beginning of 2009 then. But this was really one big question. Is it useful to initiate such a program? Because remember, behind this model, we still have the assumption that prices do not directly react. Especially if you look at all these formulas here, you do not find any P for prices. And the reason is we don't care about prices because we have assumed they are just fixed. Of course, the model we used was a little bit more complicated, and we more used an ASAD model where prices can adjust. But if you remember this, still there we assume a little friction in the prices. And we argued also that still in the ASAD model, from the general assumptions also, you can deduce that the fiscal multiplier is larger than 0, but still it is, of course, the question, is it larger than 1? Because actually, if you assume that prices can adjust, not directly, but a little bit, this means that some of this impulse, if I put into the economy additional 50 billion euros or something like this, one reaction of the enterprises, of course, can be just to increase prices. So to just absorb this additional money. Well, in 2008, during the winter, we estimated that it is not a large number, larger than 1, but a little bit. And this should be the case in order then to initiate such a program. Okay, and then also we talked about monetary policy. There we also deduced that it is larger than 0. And if you take this measure here, then we have to admit it is not that important that this is larger than 1. Because why? Well, this is just printing money by the central bank. There, in general, nobody has to repay it afterwards. Well, in the end, we have to repay it because when you take then in the long run the quantity theory of money, then of course printing money means increasing inflation. And increasing inflation means that the future value of money is less. But you do not have this direct dependence when you are talking about fiscal policy, where you really say, well, the government has to take credit by its citizens or from the international capital markets, and then you have really a contract that you have to repay it. So increasing inflation means somehow then indirect costs. But for this, you do not directly have to care that this is larger than 1. Okay. And then, of course, with monetary policy, we have this downward shift of the LM curve, decreasing interest rates and increasing output. And now, for the end today or for the last half an hour, we want to go a little bit in more detail. What are the channels of this monetary policy effect? Because in the introductory course, we more or less just argued, well, we have a decrease on via the money market because of the LM curve of the interest rates, and we have then in the commodity market a inverse dependence of investment on interest rates. So lowering interest rates means that credits will become cheaper, and that then we have an increase of investments overall, which is pushing the real economy. And now we want to go a little bit in more detail. And for this, we say, as I already argued, we have this direct interest rate effect. And this just means that, oops, this should be a C, that capital costs, the costs of a credit are decreasing. And then, as we have it quite often in the economy, we have indirect effects. And this is then an argumentation which you have hopefully already heard in microeconomics, where you have these substitution goods, where you said, well, if two goods are substitutes and the price of the substitute is increasing, then the demand for my good is also increasing because you are shifting your payments from the substitute to the other good. And also, of course, interest rates in general have an effect on income in general. Think, for example, on the inverse effect of interest rates and the stock market. So lowering interest rates means in general a positive impulse on the stock markets, and increasing stock markets means that the holder of some certificates on the DAX, S&P 500 and so on will become richer. And about these effects now we want to talk a little bit in more detail. So what does it mean if we have this first impulse of the central bank? And here now I directly argue about a decrease of interest rates and not an increase of money, because this is what we find in reality. So this means refinancing costs decrease, credit interest rates, so this feed through of a decrease of the key interest rate of the central bank means that this feeds into the capital markets, that the overall level of interest rates also is decreasing. This means that the overall sum of loans is growing. We obtain a higher credit financed demand, and then we obtain larger investment and consumption. In the introductory course, we had more or less the same slide as this, and then especially from the demand side view, output or output equals income is C plus I plus G, and if these two are increasing, then of course also production and output and income is increasing. Yeah, this we have already heard. And now let's talk about the substitution effect. So a decrease of interest rates. This means in general the return of bonds is falling. And then, as I already said, if the return of one alternative in investments is falling, then we are shifting in our portfolio to another more attractive investments. And this will be then in general, we are here in a macroeconomic view, the stock market. So we obtain a stock market price increase, and this increase will last until this point when both returns will be equal again. This is also this general argument of no free lunch in functioning capital markets. That in the end, in equilibrium, then all investments have the same return. So that then the yield at the stock markets will adjust to the bond market's return. But now the S&P 500, the DAX, and so on have increased. The stock owners have a higher income, and then by the assumption that in general we are buying normal goods, we have from this argumentation, what is a normal good? A normal good is a good where demand is increasing when income is increasing. So again, investment and consumption is increasing, and overall production, we obtain this positive effect. And then the income effect means, again, decreasing interest rates, credit interest rates are decreasing. We obtain a redistribution between creditors and debtors. And now the debtors, since the price of credits is lower, they become relatively richer. The repayment of the credits is not as high as in the past. Well, you get a credit, and then you go to your neighbor. Can I have from you for the next 3 years 5,000 euros? And remember this liquidity effect. You are losing liquidity. You are not losing your money because you have a contract that you have to repay. But you are losing your liquidity. And for this, you want to have, let's say, 5% each year of an interest rate. So this you have to pay every year. And after 3 years, you also have to repay the overall 5,000 euros. Okay? So she has an income during this time of these 5%. And you are paying this. But you have obtained the overall sum of the credit, the 5,000 euros. And now, due to the decrease of the key interest rate of the central bank, the overall interest rate level in the economy is decreasing. So she will not charge for the next credit for you again 5%, but maybe only 4%. Well, and this means that she is getting less every year. You have to pay less. So relatively, you have become richer as a debtor. Okay? And now we are looking at the distribution of incomes in the economy in general. In general, the number of debtors is larger than the number of creditors. Because when do you need, in general, a credit? If you do not have directly the cash money by your own. And since overall, if you look at an income distribution, number income then it looks somehow like this. Very rich people, we have only a rare number. But here at the median income in Germany, median income is roughly 40,000 euros. Here you have a much higher number. So, and also we have this left skewed distribution. It is not symmetric. So we have a much higher, larger number of poor people. So then we can say that a decrease of interest rates means that within the overall economy, the larger number in our society, the poor people, become relatively richer. And then think of our marginal rate of consumption, CY. There, in general, we assumed that it is between 0 and 1, and on average, we know it is roughly 0.9 in Germany. But then, of course, think of your individual marginal rate of consumption. This has not to be 90%. This can be 85%, it can be 95%. And then again, think of the poorer people. Where will their marginal rate of consumption be in general? Well, and then I argue the rich people, they more or less have already everything what they are consuming. They think of the next large ship or something to buy, or the next plane. Yeah. So if they obtain additional money, they will not really directly increase in a large amount their consumption. So in general, richer people, there we can say that this marginal rate of consumption will be less than 0.9. And the marginal rate of consumption in general of the poorer people will be larger. So if their income is relatively pushed in our society, then on average, since we have more people, more poor people with a higher marginal rate of consumption than the richer one, we obtain a direct effect on consumption via this shift of relative income in our society. Okay? So overall, there is not the argumentation that we have additional money in our society, but a shift between the groups in the society. And that this also has a positive effect, since the poorer people, which are now relatively richer than before, due to their higher marginal rate of consumption, push via additional consumption the economy overall. And so to speak, the loss of consumption, because the richer are now relatively poorer, but the decrease of consumption of these people is lower than the increase of consumption of the poorer people, since we have more poor people than rich people. Okay, and hopefully this I have written down here. So since the debtors in general are poorer in a society, poorer people consume relatively more due to the Keynesian consumption hypothesis. And then, this is what I meant, the increase of the overall poorer people outperforms the decrease of the demand of the richer people. And if we have then a delta C, which is larger than 0, then of course again yc plus I plus g, and if this is increasing, we also obtain again an increase of y. And the last one is the so-called wealth effect. There now we really need a substantially, so only just 25 basis points or something like this will not have a wealth effect, because wealth means, yeah, a longer term effect overall. This means in general, in our economy, the assumption I want to invest, do I get a credit with good conditions for me? This is here always the question. Think also of you want, as a private person, you want to buy a flat for 250,000 euro or some single house for, let's say, 500,000 euro. Most people of us do not have the cash of 200, 300, 400,000 euros. So then we are going to our private bank and ask, well, what are the conditions to obtain the rest? Maybe you have already 100,000 and you need an additional 200,000 euros. Well, if the interest rate level in the economy is relatively low, then the risk that you go to your bank and you do not get a credit which fits your conditions, what you assume, well, what can I afford to repay for the next 10 years, will be a little bit lower. And then, for what do I need a longer term investment, a longer term credit? This will be, in general, durable consumption goods. Not only a consumption for the next 2 months or so, but, so to speak, larger goods, more expensive goods. And of course, what is then the general longer term investment? This is the real estate sector, the construction sector. Remember, in Germany, it is roughly 5% of GDP. And this means also then that a substantially decrease, let's say we come from a level of 4% key interest rate, if this is substantially decreased to 2.5%, then we can expect a push to the real estate sector. And then via roughly 5 in other countries, it's a little bit larger. So let's assume in developed economies, the construction, the real estate sector is about 5 to 10% of overall GDP. Then from this component, we obtain also a push on GDP. Well, and owning a house, a flat or something like this, then we of course talking about general wealth of a person. So roughly 5 to 10% of GDP of developed countries. Yeah, and this, and then now I think 4 different channels I have explained. The direct effect, the substitution effect, these two you have already heard in the introductory course, and then the income effect. And if I remember it right, in the introductory course, I also showed you this income distribution when we talked about labor supply, I think. And yeah, we then also argued that the substitution effect is larger than the income effect, if I am right. Okay, and then the wealth effect. Well, okay, so now we have um, four channels, and then the question is how good function these channels? Well, because then we can ask, well, why do we not do it always? Or why, especially if we look at the situation after the financial crisis? So we really lowered in the end of 2008, 2009, the interest rate in Europe from a level of roughly 4.5. This was the highest key interest rate, 4.5% to zero. This at first we can say stabilized the economy, but then the next years nothing really happened. And also we started a direct effect because we could not lower the interest rates further, lower than 0%. We also started to buy with central bank monies government bonds. This would be then a direct increase of money supply, but this not really, pushed the economy. Qualitatively, of course, all this is still true, what we have talked about the last 15 minutes. And this is called then the so-called liquidity trap. So that then if we are going in the neighborhood of 0%, that then something special happens that we do not really see anymore this push effect. So let's now assume actually nominal interest rates to be zero, as I maybe also already have talked about, that if I would have went to my advisor since I wrote my PhD about monetary policy in the beginning of 2000, I started in 2001, and if then I would have asked my advisor, well, I want to write about the impact of zero interest rates, he would have said, well, interesting question, but not relevant. And we had now the situation between 2010 and 2020 for 10 years. So this was then somehow, a social experiment where we, before that, we only talked theoretically about this. So what does it mean? Well, then again, think of this general opportunity cost argument. We can also think about money as an investment. Putting it under the pillow in our bed and let it be there for the next year means an investment of, let's say, 1,000 euros. Then within a year, the 1,000 euros are still there. So the return of your money investment is just zero. You do not lose nominally something, but you also do not get something. So if then the return of bonds is in the neighborhood of zero, then this means that we are almost indifferent between holding money and holding bonds. And this then would mean that the demand of money will become highly elastic with respect to the interest rates. in the introductory course, we always said, well, we have this increasing LM curve. And as a simple assumption, just a linear line. But also, I think in microeconomics, when you looked at the price quantity diagram and on demand, in general, you have seen this for supply and demand. But then if you are really elastic in your demand, then this would mean that in general your demand curve would become flatter. Because if then prices would change, you will have a large change of your demand. And that these elasticities are in the end, the relevant numbers, which you know from the market. Because in general, we only see the equilibrium. In general, we do not see the overall supply and demand curve. Well, in the exams, we are giving you always the functions, and then you should calculate the equilibrium. But in reality, we only know the equilibrium. And then if you have to make as a manager the decision, should I increase the price of my good? This highly depends on the elasticity of demand and supply. And in general, I think maybe you have talked about this. If the demand elasticity is larger or lower than 1. Because in general, you would say, well, if I'm increasing my price, why do I do this? Well, I want to increase my revenue. But unfortunately, revenue is price times quantity. And if you are not sure that your quantity is over proportionally decreasing, so an increase of 10%, if an increase of 10% in price would mean a decrease of quantity of 20%, then of course your revenue is falling. And the same now, about the same we have to talk with respect to our LM curve. How large is the effect of this downward shift of the LM curve? And this means I should have to have an idea how this function looks like. And if I have now the argumentation that the LM curve in the neighborhood of 0 interest rates becomes highly inelastic, that then this will mean that in general the LM curve is not a linear line, but especially in the neighborhood of very low interest rates, it becomes more or less horizontally. Well, and this is then the next slide, because there the diagram looks better. So the other way around, if the demand curve is also inelastic, then this translates in a highly elastic range in the low interest rate levels of the LM curve. And then can think of, well, what happens if I perform now, starting from M0, monetary policy? So increasing the monetary aggregate to M1 and even to M2. This means downward here is happening almost nothing. The really shift outward is only relevant in the high interest rate levels, at the high interest rate levels. Well, of course, still, and I tried to show it here, still I have a positive impact on production, but this is now very, very small, because in this area where we have the cut between the IS curve and the LM curve, the overall effect, although it is still positive, unfortunately, it is only very small. And then, of course, in the long run, taking that we are seeing at the horizon the quantity theory of money, if I want to have a short run relevant effect, this would mean that I really have to increase by a large amount the monetary aggregate, but then I have this high risk of inflation in the future. And this, yeah, then maybe we have seen during these 10 years. We really tried from the monetary side to push the economy, but since we were in this interest rate level of around 0, we were catched in the liquidity trap. So although this was not a nice situation for us, it was a nice situation for economists, because then we really saw, well, our models, our argumentation worked also in reality. So, and this situation we had after the financial crisis, roughly from 2010 to 2020 in the developed countries. And now we are leaving a little bit our ISLM model. Now we also let prices to adjust. And if we then say, well, in the end, our decision variable is not the nominal interest rate, but the real interest rate. Remember, this is the Fisher equation. And if we then, due to this really push on the monetary aggregates, our inflation expectations increase, and this also has happened in this period then, that then 0 nominal interest rates, and let's assume a very high expected inflation of minus 10% of 10% inflation, would then result in a large number, negative number of real interest rates. Well, and this then would mean, well, how do our expectations in general in the economy will adjust? the real interest rates are really negative. And this will mean that I really expect that money over time is devaluing. That if I put 1,000 euros under my pillow, that this 1,000 euros are much less valuable in 1 year, in 2 years, because of these high inflation rates. And this then would mean that, so to speak, today's money would be more valuable. So that I really start, since I expect in the future the money is less valuable, that I really start to consume today. So, and this, if we have these expectations, then in general, the problem is not that serious. And actually, if we look at this period between 2010 and 2020, we really tried always every year to really increase. And especially in 2015, we started then this monthly program to buy government bonds every month in an amount of between 20 billion and 80 billion euros. And actually, in this time, the central bank, especially the European Central Bank, really tried to get the expectations of inflation upward, because we had also this situation of very low inflation rates, roughly around 1%. But then, let's say, assume the inflation expectations are the other way around. That overall in the society we have an expectation of deflation. Let's say minus 5%. And that then we have a real interest rate of plus 5%. And this then really means that traditional monetary policy cannot push the economy in the end. And if we have these deflation expectations, what does this also mean? This means that future money becomes now more valuable. And this in general would mean that I also shift in time the spending for especially larger these durable goods. So let's say, my refrigerator is still working, but I know, well, it is not working that good anymore, but it is still working. So I think of, should I buy a new refrigerator for, let's say, 1,000 euro? If I assume that this refrigerator will be cheaper in 1 year, then I will shift in time my investment in this new larger good. And this, of course, are then in general investment goods. And this is then a very, very bad situation in the economy. If I have low interest rates and deflation expectations, that then I'm really in a really bad situation. How can I come out of this situation? Because also monetary policy does not function anymore. And in this situation, Japan was for almost 20 years. After the Asian crisis in the end of the 1990s, they went down already to 0%. And if you look in the data, they really had deflation for or very low inflation rates, below 1% over almost 20 years. And they really always started to try to push somehow the economy. And this is then the reason why we are really are afraid of a situation where the expectation of price development changes into deflation. This we really try not to have such a scenario. And this was also a reason. Well, we had already low interest rate, low inflation rates after the financial crisis, why the central banks tried to push the economy, although it doesn't work. Okay, that it was then for today.